Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 421 on April the 3rd, 2026. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on Applied DIgital Corp, Firefly Aerospace, MARA Holdings, and Schlumberger Inc., and we discuss 4 new trades on Sidus Space Inc., Replimune Group, Cleanspark Inc., and JD.com. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the markets in the U.S. were closed on Friday, April 3rd, to celebrate Good Friday. That's today. Now, stocks had quite the week in the U.S. tied to war in the Middle East. The Dow Jones Industrial Average gained 1,338 points, closing out the week at 46,504 points. The S&P 500 index picked up 213 points, ending the week at 6,582 points. And now it's time for the topic of the week. The topic of the week tonight is choppy markets. Now, what do you do when the markets are up and down again, then down some more, and then up for a little bit? I'll start off by saying you always have the option not to play. If you're not being paid to manage a position in the markets, meaning you don't work for an investment bank or a trading firm or a fund or something along those lines, then you likely have the option to just be in cash. Now, if you decide to trade during choppy times, you're in for a ride. Sometimes you can end up losing money by accidentally selling low and buying high. Now, that doesn't sound right. How can that happen? Let's say you bought a stock and then the price drops. You're afraid the price will go even lower, so you sell. Of course, after you're out of the market runs back higher, and so you buy in again. Then there's news or a war or a national address by a senior politician like a president, and the price goes back down overnight. Now, at some point, you will be best served by just sitting still. This is hard because your emotions will tell you to do the exact opposite. Make your decision and stick with it. I'm a fan of using stop losses, so you can always decide how much you're willing to lose on a trade in advance. You can even pair a stop loss with a rule about when you'll allow yourself to re-enter the market. The main thing is that you have to avoid chopping your account smaller and smaller during choppy markets. Since it's Easter, some of you may be celebrating the religious holiday this weekend. I've literally had to tell myself, peace, be still, to save myself from negatively trading choppy markets. Let your long be your long and your short be short. If it's bringing you too much stress, you probably have too much size on relative to the size of your portfolio. So lower your size or walk away altogether by getting in cash. So that's it, my simple rules. Hopefully this helps out a little bit. Now let's go ahead and get into the review of last week's trades. We're going to start off with the covered call on Applied DIgital Corporation, symbol A as in Alpha, P as in Papa, L as in Lima, D as in Delta. At the time, the stock was trading for $25.71 per share. I looked at buying stock and selling the April 26 call at $2.82. That could give us a return of 12.10% in 3 weeks. Now, shares of APLD lost $1.17, ending the week at $24.54 per share. The call option that we sold lost 95 cents, leaving us with an immediate loss of 22 cents if we were to close the trade out immediately. Now, the stock price is still $1.65 above our break-even point, which means this trade is still in the profit. Even if not our originally planned profit level, it's still making money. Now, if the stock were at this level in 2 weeks, we would let that call option that we sold expire fully out of the money so that we could keep all of the premium that we collected when we sold the stock. And then we would immediately sell another call option in the month of May to further push the basis price of the stock that we have down and lock in even more profit. So this trade is still working out. I would rather sell another call option next month than roll the strike lower on this trade and change the economics altogether. So for me, no adjustments are needed at this point. Next, we have that cash secured put. I looked at Firefly Aerospace, symbol F as in Foxtrot, L as in Lima, Y as in Yankee. At the time, the stock was trading for $26.84 per share. I looked at selling the April 26 put at $2.35, hoping for a return of 8.87% in 3 weeks. Well, shares of Fly, FLY, jumped $6.12, ending the week at $32.96 per share. The out-of-the-money put that we sold is even farther out of the money. Now, you could buy it back for 70 cents, locking in an immediate profit of $1.65 per put, or you can just wait and let the put continue to depreciate as the expiration approaches and it's out of the money. As long as this stock expires above our break-even point, we'll lock in a profit in 2 weeks. So the stock is currently more than $8 from the break-even point. So this trade has worked out as originally planned. No adjustments are needed unless you want to lock in an immediate profit like I mentioned earlier. Next, we have our credit spread. We looked at MARA Holdings, the company that used to be known as Marathon Digital. That symbol M as in Mike, A as in Alpha, R as in Romeo, A as in Alpha. At the time, the stock was trading for $8.57 per share. I looked at selling the April 8/2/8 put spread at 18 cents. That could give us a maximum possible loss of 32 cents per spread. Well, shares of MARA grew 12 cents, ending the week at $8.69 per share. The out-of-the-money put spread that we sold is still out of the money, and this means the trade is working out as planned. We just want to see the stock finish above $8.50 in 2 weeks. So no adjustments are needed on this one as well. And then we have our final trade from last week was a debit spread on SLB Inc., the company formerly known as Schlumberger, symbol S as in Sierra, L as in Lima, B as in Bravo. At the time, the stock was trading for $52.32 per share. I looked at buying the April 51/52 call spread for 68 cents. That could give us a maximum gain of 32 cents or a 47% return in 3 weeks. Well, shares of Schlumberger lost $2.89, ending the week at $49.43 per share. The in-the-money call spread that we sold is now out of the money, and I would typically look to change the debit spread into a credit spread. I would then sell a downside put spread to create the iron condor. Right now, the put spreads are not really being priced at a level that supports this as a risk-reducing trade. It just doesn't make sense. That's a short way of saying the math doesn't work out. I would be adding to the total possible dollars I could lose on this trade if I were to make that sort of adjustment. So that will lead me to just relax for now and see if the stock trades higher in the first few days of next week. Obviously, we'll have a decision to make on whether or not I want to lose my full amount of capital or if I want to alter this trade and see if I can lower the risk and maybe save some of my capital. But for now, it doesn't work. I'm going to have to give it a little bit of time and see if I could get a little bit better pricing or if the stock's going to bounce back this week. We'll never know. We have 2 more weeks left until expiration. Anything can happen. So that's it for the review of last week's trades. All new trades on today's show use the expiration of April 17th. That's only 2 weeks away, so these trades are inherently more risky due to the reduced amount of time to be able to make an adjustment. With that warning, let's go ahead and dive in. We're going to start off with our covered call. I'm looking at Sidus Space Inc., symbol S as in Sierra, I as in India, D as in Delta, U as in Uniform. The stock ended the week at $3.08 per share. I'm looking at buying stock and selling the April 4 call at 40 cents, hoping for a return of 42.86% in 2 weeks. And the percentage is really that high because of the possibility of the stock running up to meet our strike. Now, you enter this trade by buying stock for $3.08 per share and selling the April 4 call at 40 cents. This trade makes the most money if stock prices finish above $4 per share. The break-even price on this trade is $2.68 per share. In real terms, the stock purchase will require $308 and you'll collect $40 for selling the option. Next, we have our cash secured put. I'm looking at Replimune Group, symbol R as in Romeo, E as in Echo, P as in Papa, L as in Lima. The stock ended the week at $8.41 per share. I'm looking at selling the April 7 put at $2, hoping for a return of 28.57% in 2 weeks. Now you enter this trade by selling the April 7 put at $2. This trade makes the most money if stock prices finish above $7 per share. The break-even price on this trade is $5 per share. In real terms, you'll collect $200 for selling the put option and you'll have $700 locked up just in case you need to purchase the stock. And then our credit spread for the week is going to be on Cleanspark Inc, symbol C as in Charlie, L as in Lima, S as in Sierra, K as in Kilo. Stock ended the week at $8.79 per share. I'm looking at selling the April 8 put spread at 16 cents. That could give us a maximum possible loss of 34 cents per spread. Now you enter this trade by selling the April 8 put at 48 cents and concurrently buying the April 8 put for 32 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices expire above $8.50 per share. The break-even price on this trade is $8.34 per share. In real terms, you'll receive $16 per spread that you sell and have $34 at risk. And then our final trade on the show today is going to be a debit spread on JD.com, symbol J as in Juliet, D as in Delta. Stock ended the week at $28.48 per share. I'm looking at buying the April 28 half call spread for 35 cents. That could give us a maximum gain of 15 cents, or that would be a 42.86% return in 2 weeks. Now you enter this trade by buying the April 28 call for 80 cents and concurrently selling the April 28 half call at 45 cents. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices expire above $28.50 per share. The break-even price on this trade is $28.35 per share. In real terms, you'll pay $35 to enter the spread, and your maximum gain is $15 per spread. So that's it for this week's show. Thank you guys once again for listening. I hope you're getting a lot out of it, and from the emails I'm getting, you guys are. So I really appreciate you listening to me talk about options. I obviously love doing it, love sharing it, love teaching it. So hope you have a wonderful weekend, and as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.